The analysis we're looking at today dives into Beyond Meat, arguing it's become the ultimate lotto ticket play for 2026 after a debt swap took bankruptcy off the table.
Yeah, a very high-stakes thesis. I mean, it's a bold move to look at a stock that everyone's saying is dead and try to find life in it.
It is. And the report does a good job on that point, noting they wiped out a huge chunk of that loan and still have that 300 million plus in revenue.
Absolutely. The survival part is there. But I think the first big area to sharpen is, well, what comes next? So the analysis really needs to connect that immediate drop in bankruptcy risk to a viable path towards long-term profitability.
Okay, so you're saying it's not enough just to prove they're not going bankrupt tomorrow? That 300 million in revenue isn't enough to justify the trade?
Well, that's the core of the weakness, right? The report identifies the lifeline, which is great, but then it sort of treats that existing revenue figure as sufficient justification for the stock to double to 250.
But that revenue is real.
It is, but it's historical. And it's a revenue figure that was generating huge losses before the swap. I mean, just because they still have it doesn't automatically fix the underlying unit economics. The analysis is leaning a little too heavily on a potential short squeeze.
And not enough on the actual business fundamentals needed to improve.
Exactly. So the suggestion is to integrate some specific, forward-looking metrics to really articulate how that cleaner balance sheet is going to let them stabilize revenue, or, more importantly, improve their margins.
Okay, so that gives a fundamental reason for the stock to rebound, beyond just a technical bounce.
It provides an anchor. You're pitching a play into 2026. You have to show how management is going to use the time they just bought themselves.
So what would that look like in practice? What kind of examples could they use?
Well, you could talk about the reduction in interest expense. That was a huge drag on cash. So where do those savings go now?
Right.
Is it going into operational efficiencies? Maybe they can finally tackle their cost of goods sold, or maybe it's for new distribution channels, or, some focused R&D.
So instead of just saying they have money, it's about showing here's how this freed up $20 million is going to lower the cost of making a burger.
Precisely. Explain which new investments will drive margin improvement from that $300 million base. You can even put a target on it, like a specific percentage reduction in COGS. That turns the story from they survived to here's how they're rebuilding.
That definitely makes the case much stronger. So, okay, that brings up the next point. The lifeline came at a cost, right? The analysis frames the stock as pocket change at $1.20, really hammering that 100% gain potential.
It does. And while that high-risk, high-reward framing is key to the lotto ticket idea, the report could benefit from a clear quantification of the remaining downside risks in that new capital structure.
You're saying it's a bit too focused on the upside.
I think the weakness is that it's a little asymmetric. It suggests the biggest risk, bankruptcy, is mostly gone, and it calls the short sellers greedy. But for an expert, that massive dilution is the new structural risk.
Ah, so the shorts aren't necessarily greedy. They might just be reacting logically to the fact that the per-share value is now much harder to grow.
Exactly. You've just made the mountain steeper, even if the peak is the same height. The report celebrates the debt relief without fully detailing the impact of that giant new share count.
So how do we fix that? How do we balance it out?
The suggestion is to add some specific, non-emotional financial data. Quantify the remaining liabilities, show the operational spending rate, contrast it directly with the debt that was wiped clean.
So you're really defining the cost of the ticket.
You have to. If you're calling it the wildest risk-reward trade, you need to show you've assessed both sides of that equation with a cold-blooded perspective.
Okay, let's get concrete. What metrics should they be plugging in?
First, the current cash burn rate, after accounting for the lower interest payments. That tells you their actual runway. Second, what's the specific long-term debt figure that's still on the books?
And what else?
And this is the most critical part, I think. Explicitly state the revenue or margin level they need to hit just to stay solvent for, say, the next 18 to 24 months.
I see. So it's not about the technical support at $1.20. It's about, do they need X million in positive free cash flow just to keep the lights on?
Yes. That grounds the risk in actual business metrics, not just trader psychology. It moves the analysis from an emotional argument about who's greedy to a logical one about financial thresholds.
That adds a huge amount of credibility.
It really does.
All right, let's move to the third point, the technical side. The analysis is pretty clear that a short squeeze is a key part of the thesis. It pinpoints 135 as the breakout and says, if they announce one good partnership, the shorts rush for the exit.
And the setup is there. I mean, a 35% short interest is absolutely dry kindling.
But the match they're proposing feels a little small, doesn't it?
Yeah, that's the thing. The technical analysis around the squeeze could be a lot stronger if it defined a more detailed and, frankly, a more impactful catalyst needed to actually force those shorts out.
So the weakness is that the trigger doesn't really match the size of the reaction that's needed. A good partnership might cause a small pop, but not a face-ripping rally.
Exactly. These shorts are hardened. They just watch the company dilute shareholders to survive. A generic piece of good news isn't going to scare them, especially with the larger share float. The catalyst has to be a genuine surprise that fundamentally changes the long-term story.
So we need to scale up the expectation for what kind of news is required to flip that many bears.
Yes. So the suggestion is to define a clearer relationship between the size of the announcement and the reaction you'd expect. Define a surprise metric. A simple profitable quarter might already be priced in by the time it happens.
Okay, so give me a concrete example. What does that look like?
Instead of just a profitable quarter, you could specify something like achieving positive adjusted EBITDA in Q4 that beats consensus estimates by, say, 15%. That signals things are improving faster than anyone thought.
Or a big partnership.
Right, but be specific, like securing a national QSR deal in a major market like Germany or the UK. Something that signals real high-volume channel penetration.
That gives it substance. And how do you tie that back to the 135 price level?
You connect that specific powerful news event to the technical trigger. You could say something like, a fundamental surprise of this magnitude must push the price decisively above 135, because that's a key level where shorts who entered pre-swap are now underwater. That gives the trigger real weight.
That level of detail transforms it. It's not just hope anymore. It's a targeted trade plan based on very specific inflection points.
It is. For a trade this volatile, the trigger has to be just as complex and just as powerful.
This has been incredibly helpful. So just to summarize the three main areas for development here.
Go for it.
First, we think the report needs a clearer link between that debt relief and actual fundamental growth. Detail how the cleaner balance sheet will fund specific operational improvements.
Right?
Second, provide a more balanced look at the downside risk. Use concrete metrics like the cash burn rate and the revenue level needed for solvency to ground that high-risk label in reality. And finally, sharpen that technical catalyst for the short squeeze. Define a much more impactful fundamental surprise, like a big EBITDA beat or a major QSR deal, and link it directly to breaking that 135 resistance level.
Absolutely. I mean, the report has a really strong, compelling, contrarian idea to start with. It makes the Lotto play case very well.